Hello, everyone, and welcome to Financial Accounting with Anne-Marie Anderson. Today we will be talking about the Statement of Retained Earnings, which is the second of the four financial statements. The Statement of Retained Earnings is a financial report that shows the changes in retained earnings, including net income and dividends, over a specified period of time. You might also hear Retained Earnings Statement, Statement of Owner's Equity for sole proprietorships and partnerships, and the Statement of Stockholders' Equity for businesses, though that one should include a few more equity accounts to be complete. Just a quick refresh. The reason we prepare this statement second is because we need net income from the income statement to carry over to the statement of retained earnings. Let's pull apart the words retained earnings. Retained means something you continue to have or have kept possession of. Earnings is the money obtained in return for labor or services. Basically, retained earnings are the profits we made in the business that we've held onto. Onto the statement. We present it with company name, title of the statement, and the time frame covered in the report. Our first item is beginning retained earnings, which is the profit we've made in earlier years. I like to think of it like a wallet or even a treasure chest where we store all of our earlier earnings. If it's a new business, we'd start with zero. Our next step is to add the current year's earnings to what we earned in the past. Don't forget, we grab that number from the income statement. At this point, I like to have a subtotal that shows what we've made in the past plus what we made this year. We have one more item, dividends. Dividends are when a company pays out some of its profits to their shareholders. Companies don't have to pay out dividends, but if they do, it's like they're sharing the wealth or rewarding their owners. That leaves us with ending retained earnings. These are the earnings that we held on to and kept in the company to grow, pay off debt, hire new employees, or help us meet future goals. You know I always like a good T account. I think it's helpful to see retained earnings in a T. Retained earnings is a stockholder's equity account, so it increases with the credit and decreases with the debit. We start with the beginning balance of retained earnings from the first day of the year, add the net income from the current year, and subtract any dividends to get to the year-end balance of retained earnings. Basically, it's a visual representation of the statement. Why is this so important that it gets its own statement? Well, retained earnings shows how much profit a company has kept to reinvest in its growth, pay off debts, or prepare for future needs. Retained earnings helps us evaluate a company's profitability, financial health, and long-term sustainability. Okay, we're done with the statement of retained earnings. But where do we go from here? The ending retained earnings balance is then used to prepare the next required financial statement, which is the balance sheet. We need that number to move forward, or our balance sheet is not going to balance. That wraps up the statement of retained earnings. Thank you for watching. If you want to learn more about accounting, please see additional videos on my channel.